Hi guys, welcome back to the channel. My name is Dave, and on this channel we talk about wealth and wealth creation. And today we're going to talk about the wheel option strategy. So stick around. Whoop! Okay guys, welcome back. So the wheel option strategy, what is it? That's what we're going to cover, right? I think before you jump right into wheel options though, you should make sure you understand basic options, and I'm going to put a video up above that kind of explains basic options. And if you understand that lingo, that's going to help you a lot here. So go watch that one first if you're not real familiar. If you understand puts and calls, buying and selling both, then you're ready for wheel options. Now, this is what works for me. I'm not a financial advisor. I'm a chemical engineer, all right? So that plays in the financial markets a lot, has a lot of history with it, but you got to do your homework. There is risk here, right? So make sure that you are comfortable before you start doing trades like this. Okay, so real quick review. If you're selling options, you're giving someone else the right. If you're selling a put, for example, you're giving them the right to put the stock to you by the expiration date. And if you're selling a call option, you're giving them the right to call your stock or buy your stock from you by the expiration date. The wheel option strategy uses both of these. And it's also known as the triple income strategy. So that's really exciting, right? Because you can have different forms of income coming out of this strategy when you combine them all together. All right, so this strategy has just a few basic steps. And the very first one is finding a stock that you like and selling a put. You collect the premium, and that's step number one. You put that premium in your pocket, and step two begins, right? That's the waiting game. Waiting game, you've got your strike price, the stock's moving along. If it expires above that strike price, you walk with your premium, and the wheel starts again. You repeat the same process. If the stock price falls below the strike price, then you're going to get put the stock, right? So now you own the stock. That's step two, right? Step three, you immediately turn around and you sell the call, right? And this is the wheel on the bus as it goes round and round. So now you've collected your second premium because you just sold the call. And now you're waiting. You're hoping that the stock continues to rise back up and that somebody calls away the stock, because we're not in this option trading strategy to own stock. We're here to churn and collect premium. So that leads to step four, which is if you can, if you're picking a good stock and let's say it's at 60, when it gets put to you and you try to sell it at 61, then you make that difference also. That's the third type of income that you can make. Basically stock appreciation, right? Going from 60 to 61, I make that $1 per contract. It can add up really quickly. So that's why it is called triple income. Now, there's a fourth type that you could possibly get, which is while you own it over maybe this 30-day period, you collect a dividend. So that's where people really dive into dividend stocks, and they look for opportunities where, hey, this could get put to me, and I'll collect the dividend as well. So a lot of people like this strategy because it churns and it creates this income. So here are some guidelines that I always follow when I'm doing this strategy. I always buy good stocks. I'm not looking for AMC. I'm going to stay away from that. I'm going to buy stocks that I want to own long term, that I would keep in my portfolio. Ones that we want to keep, ones that we want to own. So do your research. Don't just try to collect big premiums. Try to focus on buying good stocks that if there is bad news or something that comes around and you do get put a stock, you're not going, oh, geez, I wish I didn't own this. You should be like, I got it at a reduced amount. I'm feeling pretty good. Like just this last week, you saw the tech stocks dropping. I'm going to get put quite a bit, and that was one of the reasons I'm making this video. We'll show some examples. I'm a big owner of Baba now. I got my Alibaba. And I think I got some Marvell too. So, a lot of tech stocks are dropping. It was just one of those weeks. So buy good stocks that you want to own. Number two is buy a diverse mix of options, right? Of stocks. You want to be in different areas. You can buy tech, you can buy industrials, you can buy banks, you can buy all kinds of things. You don't want to put it all into one area because you don't know what's going to happen. So being diverse is really going to help you. The next thing would be, be aware of pending news, earnings, major market announcements, anything like that. The more research you can do, the more you're aware of the stocks that you're trading on, of anything that's coming out. I try to stay away. I want calm waters, okay? And sometimes that'll affect the premium a little bit, but I feel a lot better knowing that I'm not trying to guess what's going to happen during earnings. So those are the three main ones that I'm always aware of when I'm doing these trades. Okay, so don't mind this dog. Ignore the dog. I want to show you a quick example of a successful wheel that I just did as a point of reference. They're not always successful, but this is just a good example as a point of reference. Here's our example to show the wheel in action. So on January 19th, I started a trade with Citigroup. I bought 4 contracts with an expiration of 1/29. And at the time I bought them, they were at 63.5 was the price. And I sold that put, just like we talked about, at 59.5. So that was 6.3% away from the strike price at that time. But as you can see in the chart here, it was on the 19th, it was just dropping. It continued to drop. So I thought my entry point was really good, but it got assigned. So at the end of this, at expiration, it was assigned to me. I did collect, let's not forget our first form of payment, $123.92 when I sold this. And I had to have collateral of $23,800 ready there to buy when it was assigned. So that's what I'm showing here. So on this first trade here, I made 14.6% if you analyze that return over those 13 days that I held that. As I held that collateral there for them. So the second half of this is now I own the stock. So what do? It's the wheel. We got to turn this wheel. So the second part of this is on February, first day back in February. I sold those 4 contracts. 2 weeks out on 2/12. So the price at purchase was $58.45 that morning on the 1st. It was at $58.45. And I sold the call at 61.5, right? $2 difference. So 5% away from the price. And guess what? 2 weeks later, it got called because it climbed all the way back up, right? So that expired on the 12th, right in here, and it was about $63. So I left some money on the table, but we're going to turn out all right. So for that trade, for this one, I collected $205.92, and I held that for 14 days. So if you annualize that, we get 21.8%. So 2 good trades here. So now just to summarize this all together, and again, this is our good example. We wish they would all work out this way. I collected $123.205, so total premium $329, which is about 18.6 annualized. And I also got that great gain from the stock because I purchased it or was put it at 59.5 and it got called away at 61.5. So 4 contracts, 400 shares times that $2 price difference, that's $800. So when you add that total return together, $1,129 is 63.6% annualized. So great trade. Again, they're not all like this. This is a good example. I will have to dig out a bad example and show you one of those also. But this gives you the structure for the whole thing, right? This is the whole structure for selling wheel options. So the way this was presented just now, nothing could possibly go wrong, right? Well, things can go wrong. Stocks can drop 10% and then they can drop another 10% and another 10%. So what could go wrong? Well, you could buy a stock that maybe is just out of favor and it does continue to drop. So exit strategies for that type of thing is that's the time you've got to decide. You might have to take a little bit of a loss on that trade. You want to minimize those as much as possible. You want to have more winners than losers. And like I said, you want to spread it out as much as possible. But sometimes, like last year, Intel was one that bit me a couple times where it dropped after earnings. And I was like, I really want to get out of this trade. So I sold out, or I sold that call at less than what I purchased it at. And, I eventually got out of it and I had a little bit of a loss in that third form of income. And that's okay. In the long run, I've made money on that third form of income, selling the stock for more than what I bought it for. But there are times when you take little losses there. At least that's my strategy because I want to get my money back to work. So that's the biggest issue with this strategy is sometimes losing a little bit of that on that stock trade. All right, so that's wheel options trading. Hopefully that makes sense. If it does and it helped you, please subscribe to the channel. I'd really appreciate the support. If you have any questions, shout down below. And for me, options are a great source of income that are separate from my brokerage account. Again, I reiterate, I'm a long-term investor. The bulk of my investments are long-term, but I like to have this options trading account because I like this kind of source of income. It's separated enough that in a week like we just had, where my brokerage account suffered greatly, as tech stocks dropped and everything else is moving down, then my options account were very flat. I might have lost just a little bit this week, and I probably got put some stocks, but with the wheel strategy, I think I'm going to get that right back. So, hope this helped. See you next time. Whoop!